The global gold market has been making waves, and if you have been paying attention, you might have noticed something unusual. A massive surge in gold shipments from London to New York has caught the attention of investors, industry experts, and policymakers alike. What's behind this sudden movement? Why is gold flowing across Atlantic at such a rapid pace? And more importantly, what does this mean for the future of gold prices? Let's break it down. Over the past few months, nearly 400 metric tons of gold, worth an astonishing $82 billion, have been relocated from London to New York. The driving force? Fear. Concerns over potential tariffs on gold imports by the Trump administration have led investors to move their assets quickly. While there has been no official confirmation of such tariffs, the mere speculation has triggered a rush to secure physical gold in New York. This surge in demand hasn't come without consequences. In London, the time required to withdraw bullion from the Bank of England's vault has skyrocketed. What used to take just a few days now takes up to 8 weeks. This delay reflects not only the rising demand but also the logistical challenges of moving such a large volume of gold. One of the key factors influencing these shipments is arbitrage, the practice of exploiting price differences between markets. Gold future prices in New York have been trading higher than spot prices in London. This price gap has created a strong incentive for traders to physically move gold across the Atlantic, adding fuel to the ongoing surge. If you are finding this breakdown valuable, go ahead and give this video a like and share it with others who follow the gold market. Your support helps bring more in-depth analysis like this. Interestingly, the official numbers may not tell the full story. Some reports suggest that actual gold shipments to the U.S. are even higher than what's recorded on the COMEX exchange. Why? A significant portion of the gold could be moving to private vaults owned by major financial players like HSBC and JP Morgan, making it harder to track. This scenario isn't entirely new. Back in 2020, during the height of the COVID-19 pandemic, we saw a similar rush in gold shipments due to the lockdown uncertainties and supply chain disruptions. The current situation, however, is different. This time it's driven by potential tariffs and arbitrage rather than global economic lockdown. In typical US gold futures trading, contracts are either rolled over or settled in cash. But with tariff concerns looming, New York dealers are increasingly requesting physical delivery of gold, a rare move in the industry. This sudden shift has led to a bullion shortage in London and has put pressure on gold lease markets. For years, London has been the global hub for gold trading, managing everything from storage to price discovery through the local London system. However, the rapid shift of gold to US vaults is causing serious logistical challenges. The market is under strain and the effects are rippling across the financial landscape. London's status as the center for gold lending is also being tested. Normally, banks borrow and lend gold to facilitate trades, but the rising cost of borrowing gold has made this practice significantly more expensive. The usual interbank gold lease rates, which hover below 0.5%, have shot up to a staggering 12%. This drastic increase has made it nearly impossible for traders to engage in cost-effective gold borrowing. With the cost of borrowing gold soaring, short sellers, those who bet on failing gold prices, are being forced to unwind their positions. As a result, gold prices have surged past key resistance levels, nearing all-time highs. Gold has recently broken its previous all-time high, touching more than $2,950 per ounce, And with market volatility and economic uncertainty continuing to drive demand, many analysts believe gold could surpass these records in near future. So far, President Trump has not made any official statements regarding tariffs on precious metals, but speculations alone has been enough to shake up the market. Meanwhile, the Bank of England is struggling to keep up with the increased demand for gold borrowing, adding further tension to the situation. Do you think gold will continue to rise, or are we nearing a peak? Drop your thoughts in the comments. We'd love to hear your take on where gold prices are headed. Another factor adding pressure to the market is the declining availability of gold for over-the-counter trading in London. In just 2 months, 12.2 million troy ounces of gold have been delivered to COMEX-approved warehouses, pushing stock levels up by 70% to 29.8 million ounces, the highest since August 2022. Even the British Parliament has started paying attention. The Treasury Committee recently addressed the situation with Bank of England Governor Andrew Bailey, attempting to reassure markets that London remains a key gold trading hub despite the shift in gold flows to the U.S. With ongoing currency devaluations and global financial instability, some industry experts predict a major revaluation of gold and silver. The future trajectory of gold prices will likely depend on government policies, investor confidence, and liquidity conditions in the market. No matter the turbulence, one thing remains clear: gold continues to be a reliable safe haven asset in uncertain times. This latest surge in demand only reinforces the fact that when the financial world gets shaky, investors turn to gold. For investors, ensuring that their gold is real, physically held, and independently verified is more critical than ever. Allocated and segregated gold, gold that is directly owned rather than pooled in a fractional reserve system, offers the best security. The recent flurry of gold movements sheds light on the complexity of the global financial system. While we can't predict the future with certainty, one thing is undeniable: gold remains a crucial asset in a world of economic uncertainty. Whether you are a seasoned investor or just getting started, staying informed is key to making smart financial decisions. If you have made it this far, don't forget to like this video, subscribe to the channel, and ring the notification bell so you never miss an update. Thanks for watching, and stay tuned for more insights on the ever-evolving world of gold and finance.